That doesn't make you a good investor. That means that you can handle lots more risk than most people. Professor Cochran's point is that what looks like a way to earn excess returns might really be just a way to take extra risks that we hadn't recognized before. For example, there's some evidence that what people call value stocks, for now just think of stocks with low prices, tend to return more than the market even after adjusting for traditional risk measures. That sounds like a great idea to me. I'll just buy lots of different value stocks to be sure that I'm diversified. Then I'll sit back and beat the market in the long run. If I do that, though, I'll soon realize that I have a problem. All value stocks tend to move the same way. They tend to rise and fall together. I'm not as diversified as I'd thought, and I'm taking more risk than I'd thought. It's not clear that I'm really beating the market after allowing for this extra risk. Financial economists use the term efficiency to describe a market with prices that are fair given the information that we have at the time. Efficiency is a matter of degree. We all agree that the iPod and iPhone were tremendous successes that made Apple a lot of money when they were introduced in 2001 and 2007. But nobody thinks those particular bits of old news are going to affect the return he can make by buying shares of Apple today. The market is obviously efficient with respect to news that old. Most studies show that even very recent and much more subtle news won't give you an edge. Intel's stock price has gone up 3 days in a row, perhaps. That still doesn't tell you whether to buy or to sell on day 4. Kraft Foods opens a new facility. It's hard to imagine that's a surprise to guys who study the food industry for a living. But some news does help you pick winners and losers. For example, if you were Paul Moser in August of 1991, then you could indeed have made some money on some news. Moser was a Salomon Brothers bond trader who was the central figure in the Treasury bond trading scandal. Moser knew that he was about to be exposed, so he sold 46,000 shares of Salomon stock just 3 days before news of the scandal broke. The stock price dropped by 1/3 in a matter of days. So no, the market was definitely not efficient with respect to this bit of insider news. If you can uncover news like this, then you can probably pick winners and losers. Although it's worth noting that trading on insider information like this is illegal. Moser got hit with a $1.1 million fine and was barred from the securities industry for life. Experts disagree on just about how efficient modern stock markets are, but most agree that stock markets are pretty darn efficient. Even those analysts and TV ads touting products that are supposed to make you rich agree that you can't pick winners. Not without their help, at least. Stock prices are almost always going to be extremely close to being fair to both the buyer and the seller. You might be thinking, I get the point that it's really hard for people like me to beat the market. But I'm hearing a lot of qualifiers, almosts, and usuallys when you talk about being unable to beat the market. Surely there are at least a few guys who can beat the market with reasonable consistency. Why don't I just have them manage my money for me? When I hear someone say that, I think of a line that comics from the Three Stooges to Yosemite Sam of Bugs Bunny fame have used for decades. All you have to do is find the gold and I'll share it with you. Most people laugh the first time or 10 they hear this. Really? Who would be so dumb as to do all of the work to find the gold and then share the prize with someone who does nothing? So let me ask you, why would someone who can consistently pick winners agree to manage your money for you and share his winnings with you? Shouldn't we see these skilled investment managers charging high fees instead? After all, if I can beat the market by 5% a year, then you'd be glad to pay me anything up to 5% in fees because you'll still be ahead. It seems to me that the skilled investment managers ought to be the ones getting rich, not their clients. Jonathan Burke of Stanford University and Richard Green of Carnegie Mellon University have devised a great story that